Hello, everyone, and thank you for joining our Q3 interest rate webinar. For those that recognize my voice, I'm Sarah Conklin, co-host of the Rate Guy podcast, and as JP loves to say, the real boss here at Pensford. Before we get started, here are a few quick housekeeping notes. The recording and presentation slides will be sent out after the webinar. There will be a Q&A at the end, so please put your questions for JP in the chat. And just a heads up, right before the Q&A, there's a reveal you've all been waiting for, the real identity of JMO. And now please enjoy this clip of Jay Powell in all his interest rate glory. Yeah, good luck following that up, JP. I'm not sure.
Who wants to? I mean, let's just leave it at that. I think what I appreciate the most is after he held that concert, he still threw on a suit and showed up at the office this morning. So we know he's not a Gen Zer. Welcome everybody to the first webinar that involves rate cuts. It's been a while, so much better to be talking about this than what we've been talking about the last couple of years. I thought it might be fun to take a little jaunt down memory lane here. 1 day since we cut, 11 days since Tom Brady answered definitively if he's the GOAT at everything. One of the best Eagles of all time, Jason Kelce, retired 199 days ago. I'm not going to mention the whole Michigan running the ball 32 times in a row against Penn State thing. 917 days since the first hike, right? It's been quite a journey. It's been a little over 1,000 days since I last said they would not be hiking. So egg on my face. 1,286 days since the final COVID stimulus was passed. That was the 1.9 trillion that I believe probably really led to the inflation problems we've seen in the last couple of years. Interesting to note, Pensford celebrated his 15th birthday this year. It's been 5,632 days since Pensford was formed. Also interesting to note, it's been 10,462 days since the Cowboys last won a Super Bowl. Don't worry, Cowboys fans, the last Volcker hike came way longer than that. And then what feels like an eternity is 17,386 days since the real boss at Pensford was born. Been a brutal couple of years, right? Not just in the real estate space, but also for Eagles fans. We lost the Super Bowl that we should have won because of terrible grass. We had an epic collapse last year. Those of you who know me know I'm a huge Penn State fan. I had to watch Michigan cheat its way to a national title. But also real estate transactions have been brutal for the last couple of years. And I remember a good friend of mine, James, down in Dallas a couple of years ago, was the first one I heard say, survive till 25. And look how prescient that turned out to be. So kudos to James. Before we jump in, one thing to point out is all of our thoughts come from people way smarter than us. We're just disseminating it. So I try to cite the people that we most frequently rely on. My personal favorite is Anna Wong and Ira Jersey at Bloomberg. I've been telling you guys on the SMBC front, you probably have caps from them. They put together an amazing research team a couple years ago. I'd also like to call out the Fed. I know that we kind of pick on them from time to time. They have an impossible job, but they put out a ton of amazing research. And if you're not using it, I really strongly suggest it. Just go to their websites. They put up a ton of stuff. I forgot to include a bullet point here, but a special shout out to our competitor, Chatham Financial. Been competing against them for a really long time, and they've recently really made an aggressive push into the brokerage space, mortgage originations. And so that has driven a ton of broker business to us. Turns out brokers don't like sharing referrals with competitors. So thank you to them too. I normally wouldn't give a competitor airtime, but here we are. Before we jump into what we're seeing on the eco side, a couple things that we're seeing on the hedging side. Cap margins are extremely tight right now. It's the most competitive it's been in a really long time. And we're seeing sometimes 5+ banks auction, which is something that we hadn't really seen in almost 10 years. Once Dodd-Frank got passed, a whole bunch of banks pulled back. That has changed. They've gotten back into it. They've set up the back offices so that they're willing to play the volume game that SMBC dominated so much. We're seeing a lot of clients consider hedges on falling rates, whether they're trying to hedge a prepayment or I want to make sure that I can benefit from rates falling. And what I'll point out here on the left-hand side is the market share, SMBC, pretty dominant this year, 60%. Not as dominant as they were a couple of years ago when they were sort of 90 plus, 95 plus. Wells took a big chunk out of them the last couple of years. And in fact, last year, Wells was the number one provider. SMBC has gotten hyper aggressive again. But I would also say it also depends on structure. So these banks that you're seeing here tend to get aggressive depending on the structure, and it's important that you're sort of scouring the market when you're looking at that. Other thing I'll point out here is on the far right-hand side at the bottom, that's our volume year to date, and if we just divvy that up on a monthly basis, you can see the last 4 months have been much busier than the first 4 were, and really August almost matched all of Q1 in terms of activity. So to me, like the thawing has begun, like things are opening back up pretty aggressively. Now, I've been on a touch of a heater after having egg on my face for a long time, so I feel like I get to pat myself on the back once and just highlight a couple of things that ended up coming true. Mostly, I would say, is probably the job stuff. You know, you've heard Powell sort of pivot and include that a lot recently, but I think that what we're seeing is the Fed having an acknowledgement that things on the labor front are not as overheated as they were claiming they were just a few months ago. Sarah at the top mentioned we're going to unmask JMO at the end here. As a reminder, for those of you who aren't aware, we made a pretty substantial wager. I won't mention the dollar figure, but it's large enough that I'm uncomfortable mentioning the dollar figure. He got core PCE 3.0% or higher, and I got 2.99 or lower going into this year. So over the course of the year. Through July, because there's always a 1-month lag, it's averaging 2.74. He needs it to average 3.15 over the remainder of the year to win. For those who know JMO, he is very strongly opinionated, and he's been talking about inflation being a problem for like 10 years. So I believe he's had his moment in the sun. I'm glad that inflation seems to be behind us, and I'm ready to go back to more benign inflation environments. I think that there's a couple JPs that are dictating monetary policy here, and another little pat on the back here. It tends to be a correlation. When I say something, maybe it shows up in a Powell press conference a couple days later. So we vet very closely the newsletter. We have not yet seen him, but we think maybe he has set up some sort of proxy where he's receiving the information and he's making his statements and his decisions based off of what I put. You know, at least that's what I tell myself. So yesterday, a little bit of a surprise for 50 basis points, right? Over the weekend, I wrote the newsletter, came out Monday morning, and I said, hey, they should cut 50, but they're not gonna. Here's why. And it was basically because there's only a 47% chance in the market's eyes of a 50 basis points cut, right? I then said, the Fed's in a blackout period. They're not allowed to talk about what they're gonna do. And so the only way that they're gonna be able to do that is if they leak a story to the Wall Street Journal. And lo and behold, Monday morning, we wake up to not one, but 2 articles that appear to be leaks from the Federal Reserve to people that they would trust. The first is a Wall Street Journal journalist, and the second one is a former colleague, the New York Fed President, Bill Dudley. Doesn't seem surprising that he ended up calling it just a couple days before it actually happened. Anybody who watches Fed policy, what I would strongly encourage you to do is think of 60% as the key threshold. On Sunday, when I wrote the newsletter, there was a 47% chance. Pre-blackout period, 1 week prior, there's a 10% chance, right? And then an article appeared in the Wall Street Journal before this one, and the odds started ticking up. And 60% is generally considered the threshold at which the Fed will say something if they believe the market is misinterpreting, right? Sure enough, right before the meeting, guess what the odds are? 61%, right? It's not a coincidence that it came out that way. So if you're ever interested, like what are the odds that they're going to do 25 or 50, go to the CME FedWatch website, check that out. If it's north of 60, that's what they're doing in all likelihood. You very rarely see that these days. It's almost always 99% by the day we walk into a meeting. I can't remember the last time it wasn't 99%. 61 was like crazy. To recap, basically the entire meeting, I would say recalibration, right? They're acknowledging that rates are too high. They need to recalibrate and start bringing those back down over the next year to year and a half so that they don't over tighten on the economy and bring everything to a screeching halt. The Fed has Fed funds ending this year at 4.4. So they went from 1 cut to 3 to 4 cuts in just one meeting, right? Huge difference. The market says, I think you actually have one more in you. We actually think it's going to be down closer to 410. We think you're going to cut a total of 1.25% by year end. Looking ahead to the end of next year, because I'm not really sure it matters that much if we finish this year at 4.4 or 4.1. End of next year, 3.4 is what the Fed is saying. The market says, no, I think you're probably off by half a point. 2.9 is probably the number, right? And so I think if I summarized everything Powell said, and this is not a direct quote, but I think the summary would essentially be the economy is doing good and we intend to keep it that way. Like, we're going to take our foot off the brakes quickly enough to make sure we don't come to a screeching halt. If you look in the top right-hand corner, some interesting things that jumped out at me is 66% chance that we're below 4.25 by the end of this year, right? That's a pretty aggressive change from just a month ago. The odds that we're below 3% this time next year are 52%. And then the odds that we stay above 4 next year or end next year, 0%. It's just not happening, right? It's off the table at this point. Like I said about the Fed signals, you'll hear them change that tune if they believe that's wrong. But in the bottom right-hand corner, this is their own indications. They believe they're going to 4.4, 3.4, 2.9. And so they're saying we are cutting, we are taking our foot off the brakes in the coming years, and they're acknowledging they're a little bit behind, right? I think that the fact that they did 50 basis points is an acknowledgement they should have cut in July. They're trying to catch up now. Powell also said, hey, you should not interpret this as we're going to be cutting 50 basis points a bunch. I think that's a fair thing to say. I think he's trying to manage expectations, but I would also say the minute the economy starts cooling off, or if we see a really terrible jobs report, all bets are off. 50 basis points is definitely on the table. We are so far away from neutral that they need to cut aggressively, because until we get to neutral, they're still applying the brakes. I'll point at the middle bullet point in the bottom left there. 3% landing spot assumes no further cooling. That is a really important concept, and I'm not sure it's getting paid enough attention. 3% isn't the number to like jumpstart the economy. That is, nothing deteriorates from here, right? And if you look at their inflation, their unemployment, nothing deteriorates. We still need to get to 3%. If things deteriorate, they're going below 3%. And so these are those same expectations, what we call the blue dots laid out here. And it's like unemployment's only going to increase 0.2% for the next 15 months. Like, that feels pretty unrealistic to me. Maybe it comes to pass. I thought it was going to hit 5%, and it clearly hasn't. So I just think that maybe that they're underestimating the possibility of higher unemployment. Inflation's already at their year-end projection. I will note, by them cutting 50 basis points and them shifting their expectations for Fed funds much lower, they're much more in line with the market than they were 2 days ago. So to me, this is really good news that they're much more in alignment. The biggest difference is the market says you're going to get to 3% faster than you think, right? Now, we're both going to level off around 3%, but the market says you're getting there way faster than you think. And I put it here in the bottom left, Raphael Bostic, the Atlanta Fed president, made some headlines a couple of weeks ago, because here he is still talking about no cuts, right? This is 2 weeks ago. And I'm thinking, what in the world changed? He says he needs to see data. What in the world changed in 2 weeks that you went from no cuts to 50 basis points? He's a voting member. He was not the dissenter. And so how in the world can you look at us with a straight face and say, 2 weeks ago, I was in the no cut camp. Today, I'm in 50 basis point camp. I just think that the Fed officials struggle with credibility sometimes because they shoot themselves in the foot. The beige book. This really goes largely untalked about because it's about as boring as the title suggests, but the Fed takes this very seriously. I'm on a capital markets ULI council, and the Fed economists there that we get to go here speak, and they're exceptional. They're very good at their job. They always cite the beige book, and it's essentially anecdotal evidence from speaking to business leaders in their district, right? What we heard a week ago from the beige book was, holy cow, things are slowing down pretty quickly. Right, that was the main takeaway. And I suspect that dramatic change in tone in business leaders is the reason why the Fed has changed tone so quickly as well. I think it started to pile up with the jobs reports, and all of a sudden they're like, hey, wait a minute, what's going on here? And my point to a Fed economist in the spring at one of our meetings was, I don't know that business leaders are any better at forecasting 6, 9, 12 months out than any of us. So just because they're optimistic today doesn't mean they're going to be optimistic at year end. And this sort of suggests that things have changed in their mind and things are getting painful pretty quickly. I suspect this went a long way towards changing the Fed's overarching tone. It's just tough because there's not a single data point to look at inside a beige book. It's not a single number that's easy to wrap our brains around. And so for the Fed officials, we move forward, just remember, they're not always clear with us, right? I don't know if they're confused or if they have other motives. Raphael Bostic, unfortunately, also made headlines this past week, speaking of motives, where he got accused of violating trading rules, right? So things that he has direct control over, such as interest rate securities, he might have been trading in, and this just sheds a really bad light on the Fed. I think it was about 3 or 4 years ago, Powell had a couple guys who got swept up in that scandal, and I think it drives him nuts. Like, to be clear, I don't buy into the conspiracy theory of the Federal Reserve, that there's a lot of bad apples there. I think they're all just trying to do their best with a really hard job. They don't help themselves here. They don't help themselves when they say, hey, I'm going to need more evidence before I agree to a cut. 2 weeks later, they cut 50 basis points and get accused of violating trading rules. So one of my questions is, higher for longer, who's really to blame? There's this really weird correlation between Elon Musk events and what's going on with interest rates over the last couple of years. And so it really kicked off as he started acquiring Twitter. And then I'll just point out at the end, exactly 420 days since the last hike until the first cut. I don't think Powell is accusing him of not following the puff puff give down here. I think Powell's saying, hey, that's not my thing. You do you, Elon, but I'm gonna just start cutting interest rates. This is the easing off the brakes. You guys have been seeing this for 2 years now. It's still one of the most important concepts to understand why I was so confident the Fed would be cutting this year. And that is, I got popped in the nose at one of those capital market ULI events 2 years ago. It was March of 22, so 2.5 years ago. And I told this Fed economist, I'm skeptical you guys are going to be able to hike to 2.5% without something breaking, because of look at all this breaking action, right? We're kind of hooked on the sauce. And he said in March 22, we are not applying the brakes when we start hiking. This is where you're wrong, JP, right? He said, we don't apply the brakes until Fed funds is higher than inflation. Now, that took a while to get there. Now, we eventually got there. They sort of intersected around the 5% mark. But his point was, this is not braking action. This is just easing off the gas pedal, right? Those are two different things. And that was that moment when I realized, uh-oh, they might be hiking more than I thought. Now, conversely, the same is true today. Them cutting is not pressing on the gas pedal. It's them simply easing off the brakes. They're trying to apply less braking action. We will not basically get to no braking action until these two match, right? The Fed is saying core PCE is going to be at 2% in 2026. If Fed funds is at 3%, what that implies is we still have some braking action at that point. And so I wrote a quasi tongue-in-cheek newsletter a couple of weeks ago saying, listen, if they don't believe that we're currently overheated, which it sounds like they agree with, they said everything's in balance now. If we're not overheated, why do we need any braking action at all? Why not just cut to 3, 3.25, whatever that number is, and just be done with it? And let's just coast from here. Now, obviously, they would never do that, but I do think it's important to think about it in that framework, because as we cut from 550 to 350, the Fed's saying we are still applying the brakes. It's just less brakes. The Fed publishes all of these models that they use to help inform their judgment, right? You can go onto their website and see these. And so obviously they all end up being wrong in some form or fashion, but I think what I look at it and say, what is the most probable outcome over the next, let's say, year? And if you look over the next year, so sort of Q3, Q4, 2025, we're talking around 350, 375 Fed funds. Now, it depends on which model you believe. These models say cut to 3, 3.25 right now, and then coast. These other models say, no, keep it higher for longer and sort of slow glide slope. The average ends up being around 350, 375. Fed says 340. It's not a coincidence that those numbers all sort of match up. So even though these might end up being wrong, I would encourage you, just go to Federal Bank of Cleveland, and you'll see these models, because the decision makers are looking at them. They're using these to help make a decision around the next meeting. And you're going to hear a ton about r-star and neutral rate in the coming years, because essentially that's what's going to dictate the ultimate landing spot of Fed funds, which I think most people here care about. It's a relief that it's behind us. There's no more pause. There's no more hikes. Cool. But where are we going? Are we going to 4? Or are we going to 3? So let's take one quick minute to explain the difference between these two and how they're correlated and how they're going to shape Fed policy in the year ahead. So our starred is the equilibrium rate. Neither encourages or discourages growth. It's unobservable. There is no published in the Wall Street Journal, here's what our star is. And you don't know what it is until after the fact. So you're just kind of guessing, right? It's been bobbing around 1%, a little below 1% for the last 15 years, right? Neutral rate is that plus inflation, right? So this is the one you care about because those two things basically equal sort of the Fed funds natural rate. So if I add 0.9 plus 2% equals 2.9 neutral Fed funds, that's the landing spot. But that's got two components to it. The first one's the 0.9. It's unobservable. We don't know what it is. What if it's 1.5? What if it's 2? We don't know, right? The inflation, people could rightly argue, hey, the Fed doesn't believe it's going to be 2% for another 2 years. Does that mean it's 2.5 now? And then that implies Fed funds is probably going to stop at 3.5. And the answer is maybe, right? Like that's something valuable to be thinking about. One thing I will push back on is, Mohammed El-Arian's been making some headlines about talking to how the new rate is north of 4%. We went back and looked at r-star and neutral rate, and it does not change quickly. It changes very slowly. In this box, we went back and just said over a 12-month period, what's the most volatile that it's ever changed? It's around, a quarter of a point. It's not much, right? If you stretch that time frame out longer, 3 years, it gets a little wider, but it's like 75 basis points. It's still not that much. So it's tough to envision if we were at 1 heading into all this, that it's dramatically higher than sort of like 150-ish, 175. You add inflation to it, and that kind of gives you that landing spot. So could it be 350? Yes. My suspicion is it's probably closer to 3, particularly if you were to use more modern measures of inflation rather than the government's pretty stale data. Financial conditions, I've trained you guys for years. This is my favorite thing. This is the thing that I go to look at. And it's been disagreeing with everything that I've been saying for the last 2 years, which is, hey, they need to be mindful about letting off the brakes soon enough. Because this says right here, conditions are accommodative, right? That this is still encouraging growth. We are not in restrictive territory. And that goes against everything that I believe in right now. And so I will have a cognitive bias to prove my hypothesis correct. And my argument is essentially every single input that goes into financial conditions is a market input. It's interest rates, it's stocks, it's volatility, it's oil, it's all those things which have been more dramatically influenced by dropping $5 trillion into the economy than maybe the underlying economy itself has benefited from. Right. So to me, there's a chance that this is maybe things are not as accommodative as this graph would lead us to believe because those metrics are benefiting outsized. But I also think there's a chance it does imply a slightly higher r-star. I just don't think it's dramatically higher like Mohammed El-Arian does. You've probably heard this by now, but most countries had already started cutting by now. I don't believe that necessarily means that we're behind the curve with them. I do believe we're a little bit behind the curve. I don't know that means we're behind the curve with them because most countries didn't drop $5 trillion on their economy. So I think we had a lot more tailwinds we needed to work through before we got on the other side. And I think we're starting to see that now. Here's the bad news about cuts. They generally signal a recession, right? We're cutting because things are going bad. There's one giant exception, 95. Right. Interesting to note about 95 was they reduced rates 75 basis points in about 12 months. So I've been arguing, hey, they need to let out pretty quickly some cuts so that we can hopefully mimic 95. The fact that they did 50 yesterday is a little worrisome to me. It makes me wonder, well, if they only had to do 75 an entire 12 months in 95, why did they have to do 50 yesterday? And why are they calling for so much more, right? Are they seeing something behind the scenes that we're not seeing? Two other things to note on here. We all seem to remember the most recent recessions, which were painful and dramatic and kind of crazy. COVID and then, financial crisis. You go back to more normal, plain vanilla recessions, it's really not that bad. It feels like a slow period. I can't imagine it feels any worse than it does for us over the last 2.5 years. But I do think in this bottom blurb here is we're going to see a baton pass. Those of us in this business have felt like we've been in a recession for over 2 years. Most of the rest of the economy, aside from things just cost a lot more, have not necessarily felt like they're in a terrible recession. Pretty much everybody has jobs if they want them, right? I think as rates come down and capital markets start to reopen, the baton gets passed back to the economy and says, is everything okay? Are we having a lot of layoffs? Are tenants going delinquent or dark entirely? How does that baton pass look? Can we have this sort of soft landing, or are we just going to sort of run into a wall here? And so the Fed's dual mandate, largely, Powell deserves some credit here, right? We've largely brought it back into balance if we take a snapshot today. The reason I've been hammering this home all year is, hey, unemployment has this huge lag. Like, you're talking like over a year. Please stop telling me everything's good because unemployment is 3.8 today. That's got nothing to do with where it's going to be a year from now. So with a snapshot, everything looks balanced right now, just like this seesaw. And I've been using this analogy all year to try to draw this comparison. We still have a shelter component problem. We still have a quarterback contract problem, right? Turns out $240 million does not get you what it got you just 5 years ago. So this must be the impact of COVID and stimulus, because the Eagles got a lot more out of 11 million bucks than the Cowboys are getting out of 240 million bucks. Dak's great in the regular season. I'm just glad we get to face him in the playoffs too. Inflation, right? I mean, is it too early to start wondering was it actually transitory? I don't know. Transitory, if you look it up in the definition in a dictionary, it's actually doesn't leave any permanent scarring. And I would argue, it doesn't feel like we're going to have permanent scarring. Now, it's going to take some time to see that, but I don't know that we're going to have permanent scarring from this. Some people would argue, hey, we're not at their 2% target. That's okay. That should not be what's driving the decision. Number one, we've already talked about this. Their inflation measures are stale. They're way behind the curve. More modern measures, like you're looking here, the Trueflation, which is an awesome website, and Penn State's website. Obviously, I'm a Penn State homer, but still, this is a pretty epic graph. Shows we're probably sub 2% in reality if we can adjust for all these laggy things like the shelter component. And I think it kind of doesn't matter, because we've already dispelled the notion of the 2% is the ideal number, right? And I think they'll eventually get to a range or ambiguous terminology. But also, it's close enough. It's close enough that it's not the most pressing thing. Meanwhile, unemployment has increased almost a point this year. That's way more important. Americans losing jobs becomes way more important. And so as we move forward, I would not freak out if you see a little blip here or there with the inflation readings, as long as the expectations are anchored. This is what the Fed is going to care about way more, as long as inflation kind of stays below 3-ish%. Because this is a self-fulfilling prophecy. If you think things are going to be more expensive, you rush to buy. And when you buy, you push up demand. That pushes up pricing, and it becomes a self-fulfilling prophecy. And so you can see this is where inflation expectations were at the first hike. And they were like, we have to intervene aggressively. They won the war on inflation expectations way sooner than they won the war on actual inflation, right? This came plunging down. We're at 2.6 now, so you can see these expectations are already below that number. And so keep an eye on this. As long as this is relatively anchored, they're not going to care about a little blip in the core PCE number, especially in the back half of this year, because they're looking at last year's core PCE that fell off a cliff, and we're measuring against that number. And so it's likely to bump up because of something called base effect. It's just a math equation. It's not inflation reaccelerating. Don't freak out if you see a couple headline numbers this year popping back up a touch. Give it 3 or 6 months. We'll be on the other side of the base effect, and you'll see the numbers come in lower. This is what they're trying to avoid, right? Inflation comes crashing down at the expense of driving up the unemployment rate, right? Powell has been using this phrase for 4 meetings. I kept highlighting in the newsletter saying this. He keeps saying the phrase unexpected weakening in labor markets, right? No one asked him that question. He was proactively bringing it up, which tells me he was seeing something behind the scenes. He was getting nervous about stuff before the headline numbers had really done this. And I think these revisions are a part of that. We've already revised down 400,000 through May, right? And that's just because we haven't gotten the last 2 yet. Every year, the BLS does an annual revision, and that number just came out a month ago, and they said, oops, we overstated job growth last year by 818,000. that is after they had already revised 10 out of 12 months lower, right? So that number is well over 1 million if you just take the initial number and the ultimate number. And then last but not least is this thing called QCEW, which is kind of considered the gold standard for jobs. It's just insanely stale. It's over a year old by the time you get it, but it's the best one. That implies about 1 million jobs overstated last year. We don't have the number yet, but when it comes out, that will likely say we overstated by 1 million. If we could go back to every single month and redo the headlines, would we all feel the way we do about the job market being so gangbusters if we subtracted, 100,000 per month off of it? So SMBC's team puts a lot of great stuff out about the labor market. One of the things that they are hammering home is that construction jobs right here, that these are really highly correlated to the building permits, and there's this disconnect happening right now, and it's disconnected in a way that it's never been disconnected before, where the hiring is outpacing the permits. And so their argument is construction alone probably has 500,000 too many employed people right this second, right? So you divide that by 12, that would be on average 42,000 people per month losing a job over the next year, right? Imagine the drag effect that something like that might have on the headline jobs that we see. But it's not just construction, it's kind of spread throughout all these different sectors, and there's lots of signals, and I think Powell's finally picking up on it that, hey, this is not as good as we thought it was. Claudia Sahm is a well-known Fed economist. I was stunned to learn a year ago that she's still like an active economist. If you can go and follow her on LinkedIn, she posts really thoughtful stuff all the time. Her Sahm rule has been triggered. We included that a bunch of times last year because we just kept butting up against it. She herself said, hey, this time might be different. Just because it's been triggered doesn't mean it's necessarily going to be a recession. Every time might be different. And, as we saw in some of those non-financial crisis recessions, there's just a general cooling off. They're a little negative, but it's like the wheels didn't fall off, right? And that might be what we see this time, especially with all those tailwinds that we've had over the last couple of years. The number of conversations that we're having with clients right now about how to hedge in an easing cycle is kind of mind-boggling. So I'm going to highlight just a couple things here. You guys probably don't love hedging discussions as much as I do, but obviously the doozy is, thank God cap prices have come down. It has been a brutal couple years. And so you've got a 375 strike, a 475 strike, and a 575 strike. These are their actual real world price changes to date, right? This is the last hike. And so we had higher for longer and then higher for longer 2.0. And so this caused this artificial plateau. Towards the end of the year, everybody realized, wait a minute, nope, they're not hiking anymore. And then all of a sudden in the spring, we had this like 2.0 higher for longer and it just took off again. We're now way off of the peaks. Cap prices are so much more manageable now. And if you have a high strike, 575, 475 is getting there, not quite, but almost there. You've basically arrived at the bottom, right? You're not going to see a ton of improvement from here. In the money guys, you still can expect to see some improvement, probably through year end. So we're having a ton of discussions around that to include, hey, should I buy a 2-year cap now or should I do 2 1-year caps? Do it for a year, buy another one a year from now. And it kind of depends on the strike, right? And so this is where we work closely with our clients and we say, listen, if the market backs out just 2 cuts, right? They're now saying 290. They say, you know what, 350 is the number. Over the course of the next year, if your strike is above 3, you're better off waiting off. You're fine, right? But if you have a low strike, if you're below 3%, it's probably going to cost more than it does today. That's how valuable those 2 cuts getting sucked out of market expectations out of the forward curve end up being. You can see if you have a really low strike, it might cost you $200,000-$300,000 on this sort of structure. So just be mindful of that. Call us up. We can put together custom analysis on your very specific structure. But the idea is, in general, high strike, wait. Low strike, go ahead and consider buying. And so some of the unique things that we've seen in the last sort of 6 months or so is, we've been pounding this table about buying floors out. Like, please consider doing that. And don't be shy about just saying, hey, where's the market value of this? My lender's putting this in at 4%. What does the market say that is worth? Because you should be negotiating that the way that you negotiate a loan spread or the swap credit charge, right? Like, these are economic impacts to you. go find out what the market says it's worth so you can have a negotiation with your lender. We've had people who have sort of been steered towards fixed rate debt that maybe would prefer floating in general, but they've gone the fixed rate route because of proceeds is generally the number one reason. Well, you can buy a floor and it ends up converting it back to floating, and it behaves like a floating rate deal with a cap, with the fixed rate as the cap. Lots of corridor structures that we've been considering, they make decent sense now with a falling rate environment because the high side risk is essentially negligible. Fixed rates falling, swaptions are always the go-to, and that might be to hedge a prepayment penalty. Maybe you're finally selling something, you've got a yield maintenance or a defeasance that has sprung up. You can hedge that risk to make sure it doesn't move against you during closing. Rate lock remorse, we named this after a client who came up with this idea. He said, the minute I lock, I know rates are going to plunge and I want to be able to benefit from that. And so he bought a hedge on just 50% of it. He didn't do all of it, but he just said, I want to pay some amount of money that if the bottom falls out, I'll be able to benefit from that on this. In the bottom, this is where we're spending a lot of time because I think this is actually a very realistic outcome. And that is, what if rates fall less than expected? What should I do? How should I hedge that, right? And there's lots of choices here. But as we just saw on that prior page, the market is really aggressively pricing in a cutting cycle. And we have tailwinds from fiscal stimulus that we've never really seen before. So I think there's a chance we don't get down to sub 3% by the end of next year. And if that happens, how would you have wished you had considered hedging this, right? And so we have different ways. So what I would tell you is, if you're considering something, just call our team up. We love walking through this. You know, we get paid by doing the actual transaction, but this is the fun part of the job. Speaking of fun part of the job, Sarah gets to come up with cool Photoshops of me, what to expect when you're expecting rate cuts. So this is essentially, what do things do after the first cut, right? And let's start with the unemployment. I told you earlier, unemployment is a terrible leading indicator. It does not usually start to rise until about 6 to 12 months after the first cut. We've already seen it climb a bunch. That's atypical. Now we're coming off the all-time low, so maybe you can account for that. But what I would say is, it's highly probable that the Fed is not going to only experience 0.2% increase in unemployment over the next year. That feels unrealistic. Now, maybe we don't get to 5.7, but 5 certainly feels reasonable. That doesn't even feel like an outlier. So this is just, what does unemployment do after the first cut? Same concept for non-farm payrolls. So we normalize this at 0. This is not 0 non-farm payrolls. It's just on the day of the first cut, whatever it's been averaging, I want you to use that as 0, right? And so generally speaking, except for that 95 soft landing, we generally see jobs about 6 to 12 months in start to tick down, right? You have fewer jobs gained than you did before. The last 3 months average is 116. That is barely keeping pace with population growth. As you can see over here, 12 months from now, the average cycle says jobs are down 129. There's a very real possibility, before even accounting for all these revisions they've been doing, that we have negative job growth, aka job losses, a year from now, right? That's what I think is keeping the Fed up at night at this point. The forward curve always underestimates the path. Again, we normalized on the day of the last cut. This gray dotted line you see in the background, that's the forward curve. It's pricing in the dip. So don't think that means it's flat. What this means is, this is the forward curve already reflecting sort of 3% as the landing spot. How do rates generally end up performing relative to expectations? And the answer is almost always down pretty consistently a point within a year, right? 2% in 2 years. Now, there is one giant caveat here, and that is, generally speaking, when the Fed is cutting, it's because the wheels are falling off, right? And I'm not sure that the wheels are falling off yet. I think that there's a chance that maybe they won't have a soft landing, but it won't be a hard landing either. And so these scenarios generally, because the Fed waited way too long and they start to slash and burn, but by then it was too late and the wheels are falling off. And so we end up having way fewer jobs than we expected. But if the market is saying, hey, SOFR is going to be around 2.9 at the end of next year, what that suggests is there's a chance that we're sub 2% this time next year or at the end of next year, even though it sounds kind of funny to say out loud right now. It wouldn't be unprecedented. Same concept with the 10-year Treasury, except the 10-year Treasury generally moves in advance of the Fed cut or the Fed raise, and then kind of waits for the Fed to catch up. So we've seen that over the last couple of months. The 10-years come plunging down, sort of 365, 375-ish, right? And now it's waiting for the Fed to catch up. And as the Fed starts to massage its projections, and as the data comes in, imagine just the 10-year Treasury just trying to predict where Fed funds is ultimately going to land, right? That's kind of what it's trying to do. It's trying to recalibrate as we move along from here on out. Do not assume the 10-year Treasury is going to move down just because the Fed is cutting. It already did that, right? It already priced it in, right? And so, even when the wheels normally fall off, you only see a 75 basis point drop. So 375 to 3 would be what we normally see, but the wheels have not yet begun to fall off. So most times when we see the Fed cutting, it's because things are getting bad very quickly and they're slashing and burning. We're not feeling that yet. So we tell our fixed rate borrowers, listen, maybe the 10-year gets to 3, but you should not assume it's getting to 3 just because the Fed is cutting. In order for it to get to 3, things have to get worse than we're currently expecting. And so we get asked this question a lot, like how is it tied to Fed funds? And you can track ranges and all that stuff, but I would basically just say it's trying to predict the ultimate landing spot. The 10-year Treasury had already priced in the Fed funds cutting to 280 when it was at 370. If you think it's going to be lower than 370, what you're really saying is, I think the ultimate landing spot is below 2.8, right? If you're a fixed rate borrower, that's how you should think about this. And if 3% is the true neutral rate, if that's the right number, what that suggests is the market is not pricing in a recession. It's pricing in a nice, slow recalibration down to 3-ish%, and we avoid a recession, right? If we have a recession, rates are going to go lower than currently projected. So you can see the forwards market got 1-year forward is like 6 basis points lower than a spot. Bloomberg, who puts out great stuff, year-end 366 and 350. All that will change if the data starts deteriorating, right? This was another big reason we saw such a dramatic movement over the last couple months, and that was shorts were getting crushed. And so they were covering their shorts dramatically. You can see how dramatically they had to cover. We're almost back to neutral. Maybe this slides into longs here, and that drives the 10-year Treasury lower. My expectation is we're probably just pressing the reset button, and we're just sort of shedding all those shorts, that higher for longer mentality that you're seeing here and here, and instead say, let's get back to neutral. Let's start over again. We will react to data as it comes out from here on out, which tells me we're probably range bound for the foreseeable future. And right now, the low end of the range is around 335, high end of the range is 378. We get asked a lot, where do you guys get these numbers? We talk to traders all the time. Bloomberg puts out some really good stuff. And it's more of an art than a science. There's no guarantee any of this is right. But what it does do is generally give you a sense of, hey, if we're below or above these numbers, it's going to take a catalyst. Something has to happen in order for us to break through. And I just don't know that we're going to have that thing anytime soon. If the Fed meeting just happened yesterday and we didn't see long end rates go crazy, or like they moved a couple basis points. But the uninversion probably means there's a recession coming. There's generally about a 7-month lag. And so don't be surprised if we do have a recession. I don't know that it's going to be a nasty one. I think there's a chance it's just, a pretty plain vanilla recession. I think that there's a chance that we don't see nearly as many layoffs as we used to see, because people who make hiring decisions have such memories about how hard it was to get people that they're unlikely to let people go. But curve uninverts is the signal that there's a recession, not the actual inversion itself. So that takes us to, all right, great, now what, right? So Fed funds, I'd say, listen, we got at least 50 basis points more by year end. I think it actually could be more. I think Citi and Wells, Jeffrey Gundlach are in that camp. And I'm just rooting for it because I said it would be 1.25 this year, and I would love to have something to hang my hat on. I think they'll do more than a point next year. I think we have a lot of breaking action we need to get out of the system. They're calling for every other meeting, 25 basis points. That feels way too predictable to me. I just don't see that happen. I can't stress this enough. If you don't remember anything else from this webinar, it is this. 3% landing spot assumes no further cooling. That does not mean they are trying to stimulate the economy. That means no more cooling. If things get worse from here, the landing spot is not 3. They have to go below 3 to kind of re-accelerate things, right? And I believe the faster they cut, the more likely we are to have a soft landing, right? I think that's part of the reason why they did 50 basis points. They're like, let's get this breaking action off the economy ASAP, and let's recalibrate, right? And if we need to get to 350 or 3.25 really quickly, that's what we will do to protect jobs. Because as you can see in this top right-hand one, they have changed their tune a ton. From this job market is the greatest job market in the history of the universe and incredibly overheated to we're seeing some things that worry us, right? And I've sort of been joking for the last couple of years that everyone's a tough guy until Americans start losing jobs. And then it becomes really hard to hold the line in monetary policy discussions when people are losing their jobs. On the 10-year Treasury front, I just don't think that we're going to break through 335 or 4 unless something dramatic happens. I think 335 is probably the most likely thing is unemployment surges through 5%. That's the sort of thing that would cause that to happen, jobs, right? Going back up through 4 is really tough to envision right now unless them easing off the brakes very clearly starts helping the economy, coast and maybe even start to reaccelerate. If that happens, I could see it go above 4. I don't think it's going back to 5 anytime soon with the Fed cutting so much. And then inflation, we might have a few bumps here and there, but largely it is contained, it's passed, and I think there's a chance that with the benefit of hindsight, economists will be describing it as transitory. Unfortunately, probably going to end up seeing Belichick in an Eagles gear at some point, maybe before year end if they keep playing like they did this past weekend. There in the bottom right, I got a text from a good friend out in LA who said, "You are the GOAT." And so when he said that, because he's kind of like my hype man, it's like who I need to go talk to before I do like a webinar, make sure that I'm feeling the energy. And this is what I'm picturing, right? Tom Brady in all his glory. I'm thinking of all those times that I've been right. And then Sarah might casually remind me, maybe Warren's talking about that other picture of the GOAT with Tom Brady. And so I don't like to really spend a lot of time on this page because it's kind of painful to see my own words thrown back at me. But I would point out Tom Brady's wearing weird gloves with a goat. And so take that as the takeaway from this page instead. Turns out Sarah's right. I am wrong quite a bit. And so she promised that we would unmask JMO. And so I'm going to start with this. It all makes sense in a second, but we are really big supporters of something called Dazzle the Dot. It's a Dottie Rose Foundation. It's a Girls in Tech Foundation. We're big supporters of that. Sarah's on the board. Unfortunately for me, once a year, their event is this gala where you get dressed up in crazy stuff. And so last year was the second time I've ever worn a tuxedo in my life. That's me over here, hating my life, heading for the exits as Sarah is bringing up the rear, trying to steer me back in. Unfortunately, this is me at prom, and I propped the poor girl out who went with me. I feel terrible for her, but as Sarah likes to say, hard to understand why you were single when I met you. And I just wish I looked like Jay-Z in a tuxedo. It'd look much better. But I bring all that up to say, here's why it matters, is that JMO is John Morris. He's a senior partner at Beacon. If you look up here, I'll try to point out, that framed contract was signed by Beacon back in 2009. First contract I ever had. They're my first client ever. So he and I are very good friends. It's a great company. I've been giving him a ton of grief over the past year. He's incredibly thoughtful. And other than inflation, he is very open-minded about having thoughtful discussions around things. So he's always soliciting people's ideas on things. And so I have thrown him under the bus a ton this year just because he's a good sport. The reason I bring this up is because he threw in the towel on our wager a couple weeks ago after the last core PCE. He said, I clearly can't win. You were right. I was wrong. You are smart. I'm not. You're incredibly handsome. I am less so. And I said, John, that's enough. We get it. I'm better than you. And I said, but to display my incredible graciousness as a winner, how about instead of you paying me cash, you make a check out to the Dottie Rose Foundation to support this charity that's near and dear to our heart. And then also you get a tax write-off. And so because he's such a good man, he then increased the amount that he sent in by 50%. The check did clear, and it cleared because JMO has been in Southeast Industrial for like 30 years. He's doing fine, but it's been fun to badger him for the last year, and he's been a great sport about it. We are good friends. I do love him dearly, but he did pay off the wager, and so unfortunately I won't be able to keep talking smack about him. So I think we have a couple minutes left, Sarah. If there's anything that popped up in the chat, I'm happy to answer a couple questions.
Yeah, sure. And thank you again, JMO. We are very, very appreciative of your generosity, and a lot of girls will benefit from that. So, top questions. We had a lot of election questions top of mind. Who wins the election, and how will it impact rates?
I mean, come on, like that's what we're starting with.
Yeah.
So we've already covered repeatedly that it doesn't matter who wins the election, generally speaking. I think if there is a sweep between Congress and the White House, regardless of which side, that would be the scenario that would most likely result in, a 25 to 50 basis point pop in long end rates. I'm kind of selfishly just sort of rooting for the White House and the Congress to be divided, and we can just have a little bit of gridlock so that nobody goes and spends a ton of money like they have been the last couple of years. I do have a wager on the actual election itself, a small wager with a colleague at the office. He has Trump, I have Harris, and I believe it's a total coin toss right now. And the only reason I took it was because Trump seems more likely to shoot himself in the foot between now and November 5th than Harris. She might not say anything of value whatsoever, ever, but she's less likely to shoot herself in the foot, and I can see him doing and saying things that would lead people to say, I'm just pulling the lever for her. Let's all come back up for air in 4 years.
This is totally changing gears, but what's the coolest hedge idea that you've done?
I would say this year has just been a bunch of fun hedging discussions. You go back to pre-COVID, everything was 15 grand for a cap. And so there weren't a lot of strategies going on. So we've done way more hedging strategy calls than we've ever done. And we love doing them. So if you ever want to talk about that stuff, please call us. We had a lot of clients who had bought really low strikes, caps, let's say 1%, and they were worth a ton. And they've been reading the newsletter saying, hey, it looks like these might lose a lot of their mark-to-market value in the coming year, or once everybody knows the Fed is cutting. Is there anything we can do to protect that? Like, these things are worth, $10 million, $20 million. And so what we ended up doing was monetizing a portion of the cap. Let's say they had a required strike at 350 and they had bought a cap at 50. We would monetize the difference just between 50 and 350 and stick it in an escrow account, right? Raise the strike to 350. You're still meeting the lender's requirements, but you're almost like shielding the economic value of that 3% and saying, let me just stick it in a rainy day account. I'll pay out of that. But now that money, let's say it's $5 million, that money can't lose mark-to-market value once we all know the Fed is cutting. It can't get cut in half just because the Fed starts cutting. And so that has worked out remarkably well for a bunch of clients this year who just said, let me just monetize that amount, raise my strike up to the max strike, and protect my investment, essentially.
And we're going to finish with just more of a statement than a question. Tom says that Bill Belichick would never tolerate Jalen. Not a question, it's a fact. And I just had to throw that in there. I don't think he's wrong. Do you?
I don't know that I have an argument to that. It would be interesting to see Belichick mesh his personality and his style with the culture that Sirianni has built over the last couple of years. It's sort of the Gen Z versus whatever Belichick is. I don't even know, Gen like Charlie or something. But I don't even care. Like, let's just try something different, because this guy should have been canned last year, and we're seeing why right now.
Well, that's all we've got for you folks. I hope you guys enjoyed it. Again, just remember the slides, the recording, everything will be sent out. You don't have to email our team. It'll automatically be sent out in a couple of days when everything's formatted. And always, if you have questions, our team is standing by to answer any and all that pop up. Thanks for joining us, everybody.
Thanks, everyone.